Yet another day of side streaming. This thing's getting up boring for the counting stuff. But let's continue. I think it might get better eventually. Let's see. Let's go.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to pick up where we left off last time and continue to do the initial transactions for the relic spotter case. Got a lot to get to, so let's get started. Let's start back up with transaction number 7. On June 15th, Park ordered $2,000 of sundries inventory, for instance, water bottles, energy bars, etc., to be delivered on June 30th. Park was able to purchase the inventory on account, which meant she had up to 30 days after delivery to pay the supplier. So I'd like to start with cash, but there's no cash in this transaction. We're receiving inventory, and we owe the supplier money for the inventory within 30 days. So let's start with inventory. Inventory is an asset. Assets go up through debits, so we're going to debit inventory for $2,000. We owe money to our supplier. That's a liability. Liabilities have credit balances, so we increase them with a credit. So we're going to credit something called accounts payable for $2,000. Accounts payable is the term we always use when we owe money to a supplier.
Hey, when is the date for the transaction June 30th and not June 15th?
Good spotting. On June 15th, we placed the order, but there's no transaction yet because we haven't had an exchange of cash, goods, or services. It's not until June 30th, when we take physical delivery of the inventory, that we have to record a transaction. We post this one to T accounts. There's no cash T account this time. Instead, we create an inventory T account with a debit balance and create an accounts payable T account with a credit balance. Transaction 8. On June 30th, Park paid $2,100 for a 3-year site license to use geocontour mapping software in the metal detectors. For the journal entry, we're back to paying cash. So we'll start with cash. Cash is an asset. Cash is going down. We make assets go down with credit. So we credit cash for $2,100. Now what are we getting? What's the debit? So the debit here is that we're getting software. Now, I never knew that metal detectors ran on geocontouring mapping software, but I guess they apparently do. Anyway, software is going to be an asset because it's something that we can use to run the metal detectors over 3 years. Assets go up with debit, so we debit an asset called software for $2,100.
Excuse me, I hate to sound like a broken phonograph record, but why is this an asset and not an expense?
Don't feel bad for asking the question. One of the trickier things to pick up in accounting is when you spend money, do you recognize an asset or do you recognize an expense? In this case, we did an asset because we're going to get 3 years of future benefits from buying the software. And in future videos, we'll talk about what has to happen for this asset to then turn into an expense, as it will down the road. We post this journal entry to T accounts by putting another credit on the right-hand side of the cash account and creating a new T account for the software asset. Transaction 9. On June 30th, Park signed a contract with a local advertising agency to provide various forms of advertising for a period of 1 year. She paid $8,000 upfront for advertising through June 30th, 2013. For this journal entry, we are paying $8,000 of cash. Cash is an asset. We make an asset go down with a credit, so we credit cash for $8,000. And by this point, you should be able to credit cash in your sleep because we've done it so often. Every time we pay cash, it's a credit to the cash account. Now we need a debit, so what are we getting for this cash? Well, we're getting a year's worth of advertising without having to pay any additional cash. That's an asset. So we're going to create an asset called prepaid advertising. And since it's an asset, we increase it with a debit. So we debit prepaid advertising, $8,000.
Do we also get to record the value that this advertising will create as an asset? I mean, this advertising could bring in extra $100,000 to the bottom line. Sounds like an asset to me.
It's important to note that the asset here only represents the cost of the advertising that's been prepaid. It doesn't represent any of the potential value that the advertising could bring us in the future. We don't record that value as an asset because the benefits cannot be measured with a reasonable degree of certainty. It's just like the brand name example we looked at in a prior video. If there's too much uncertainty about the value of the brand or the value of the advertising, we err on the side of reliability and don't include it as an asset. We post this transaction to T account, so we've got another credit to cash on the right-hand side, and we create a T account for prepaid advertising with a debit of $8,000. Transaction 10. On June 30th, Park needed cash to make a payment on the Imperial Bank loan that funded her purchase of Relic Spotter stock. She borrowed $5,000 from Relic Spotter at 10% interest, with the principal and interest due in a lump sum on June 30th, 2013. This transaction looks complicated, but let's just start with what we know.
Borrow
So what we
5K,
know is
so
that Relic Spotter paid $5,000 cash to Rebecca Park.
cash
We're
increase
paying
with
cash.
the debit.
Cash is going down. Since cash is an asset, assets go down with credits. We credit cash for $5,000. So what is Relic Spotter getting for this cash? What's the debit? Well, essentially, they're making a loan. That loan is going to be an asset because they're entitled to receive $5,000 of cash back from Rebecca Park at some point in the future. Since it's an asset, we want to debit the asset to increase it. We're going to call it notes receivable and debit notes receivable for $5,000. Note that we call it notes receivable and not accounts receivable. Accounts receivable is only used for customers, when customers owe us money. If an employee owes us money for a loan, we're going to call it a notes receivable.
Hey, wait a minute. The last time Park borrowed money for herself, we didn't record it in the company's books. Yes, is this another trick question?
You're correct that in both cases, Rebecca Park was borrowing money on her own account. What's different was that in the first example we saw, she was borrowing it from the Imperial Bank. In this transaction, she's borrowing it from Relic Spotter. That means that Relic Spotter is giving some of its cash to Rebecca Park, and Relic Spotter has to record a transaction for that disbursement of cash to Rebecca. We post this to T accounts with another credit to cash, and we create a T account for notes receivable. Transaction 11. On June 30th, Park also hired 2 employees, Linda Carlisle and Charlotte Cafferly, to run the shop. They signed employment contracts promising each salaries of $32,000 per year.
No transaction.
So the journal entry here, well, let's stop and think for a minute. Is there actually a journal entry needed? Has there been a transaction? We haven't paid any cash yet to these 2 employees. They haven't done any work for us yet. All that's happened is they've signed a contract, but that's the kind of promise that we don't account for. So there's going to be no journal entry. There's no journal entry for this employment contract because they haven't worked for us yet. We haven't paid cash yet, and so we don't consider this a transaction. We don't account for this type of promise.
So here's your trick question. Where I come from, when you promise something, it becomes an ironclad obligation. So wasn't this a liability?
I'm sorry to cause so much stress, but we did talk about this in the liability video. Remember, one of the criteria for recording a liability is the obligation has to be based on some benefits received currently or in the past. We haven't received any benefits from these employees yet because they haven't worked for us. In fact, they could quit tomorrow and we wouldn't owe them anything. So it's not until they work for us without being paid that we would record a liability. Since there's no journal entry, there's nothing for us to post, so let's go on to transaction 12. On June 30th, Gerard called from Saint-Tropez to check in on the business. Upon hearing that Relic Spotter only had $47,000 of cash left in the bank, Gerard became concerned about his investment. Now there's more to this transaction, but I want to cut in here for a second to show you how we could figure out how much cash Relic Spotter has in the bank. If we bring up the cash T account, at this point we could draw a line, add up the debits, add up the credits, subtract the credits from the debits, and we'd have a balance of $47,000. So at any point you can draw a line and figure out a balance, and at this point we have $47,000 in the cash account. Okay, back to the rest of the transaction. Thinking fast, Park stated she was so confident of Relic Spotter's prospects that she was declaring a 10-cent per share dividend to be paid on August 31st. So that's $25,000. This dividend seemed to reassure Gerard.
Return earning.
So for the journal entry, is there a journal entry here? Because we haven't actually paid any cash yet. Has there really been a transaction? Well, as we talked about in a prior video, the custom is that when a company declares a dividend, you make a journal entry at that point, even though the cash will be paid later. So on June 30th, we need to reduce stockholders' equity, reduce retained earnings to recognize the dividend. Reduce stockholders' equity, a credit account with a debit entry, so we're going to debit retained earnings for $2,500 to take out the dividend. The other side of this is that, as we talked about in a prior video, once you declare a dividend, essentially you're holding the cash that belongs to the owners until you write the checks. So we have this obligation to write those checks and deliver the cash. That obligation is a liability called dividends payable. We make liabilities go up with a credit, so we're going to credit dividends payable for $2,500.
Whoa, I thought you said liabilities were obligations to non-owners. The dividends are owed to the owners. How can you possibly justify having a dividends payable here? And how can you record dividends on the date they are declared? I thought you said that we don't account for promises. Wouldn't it make more sense to wait until they are paid?
Whoa, let's settle down. Someone needs to take a chill pill or something. We did talk about this in a prior video. I agree it's not very intuitive, and that's why I wanted to review the transaction again. By convention, when a company declares a dividend, it takes it out of retained earnings at that point, even if the cash is going to be paid later. And at that point, the owners become creditors because the company is holding their cash until the dividend checks are sent. So just memorize this one because, again, it's not very intuitive. We post this to T account, so we create a T account for retained earnings, a stockholders equity account, and we have a balance on the debit side, and a T account for dividends payable liability where we put in the credit entry.
What? How can retained earnings have a debit balance? According to my notes, it is a stockholders equity account and should have a credit balance.
Wow, you've been taking notes? That makes me feel good. You're correct that retained earnings is a stockholders equity account, and stockholders equity accounts have credit balances. But to make sure that the balance sheet equation always stays in balance, we need at least one account that can be either a debit or credit balance. Imagine if we had more liabilities than assets. The only way we could get the balance sheet equation to balance would be with negative stockholders equity. And so we make an exception for retained earnings and allow it to have either a debit or credit balance because it's the one account that makes sure that the balance sheet equation always stays in balance. If retained earnings does have a debit balance, oftentimes we change the name and call it something like accumulated deficit or accumulated losses. Transaction 13, Relic Spotter opened for business on July 1, 2012, just in time for the big Independence Day weekend. On July 31st, Park paid the supplier the $2,000 it was owed.
Debit to credit to
For this journal
cash.
entry, we're paying $2,000 cash. Anytime we pay cash, we credit it, so we credit cash $2,000. The debit here is that we're paying what we owe the supplier. What we owe the supplier is an accounts payable, which is a liability. So if we're paying the supplier, the liability is going to go down, and we make liabilities go down through a debit. So we debit accounts payable for $2,000, which reduces the obligation by $2,000.
I think we actually understand this one. Go on.
We post this to T accounts. There's another credit entry on the right-hand side of the cash T account, and a debit to accounts payable. And notice at this point, the balance in accounts payable would be zero, which makes sense because we don't owe our supplier any money anymore. We've fully paid off the liability. Transaction 14. On August 31st, Park paid the $2,500 dividend that had been declared in June.
We already did it before.
For the journal entry here, we're paying $2,500 cash, so that's a credit to cash for $2,500. The debit is going to be to dividends payable because we're paying off what we owe the shareholders for the dividend. Thus, we're reducing the dividend payable liability. We reduce liabilities with a debit, so we debit dividends payable for $2,500.
Excuse me. So, it looks like every time you pay cash to settle an obligation, you debit some payable and credit cash. Is that correct?
Yes, that's exactly correct. Every time you pay down a liability, you debit the liability and credit cash. Looks like it's starting to sink in. We post this one to T accounts with yet another credit to cash and a debit to the dividends payable liability account, which, as you can see, zeroes out this account, which makes sense because we don't owe our shareholders any more money for the dividend. And that's a wrap for the first part of the case. We'll pick up the case again after we learn about revenues and expenses, which will allow us to start generating some profits for Relic Spotter. I'll see you next time.
See you next video.
Hi, I'm Professor Brian Boucher. Welcome back. Wow, what a long week of watching videos on the accounting basics. So what I want to do in the last video each week is look at a real financial statement so that we can take the things that we've learned in these lectures and see how they play out in a real world financial statement. And to do this, I want to use the same financial statement throughout the course. The statement I chose is the 3M company. In case you hadn't noticed, I'm from Minnesota. There's a Vikings helmet over here and some hockey helmets and a Gopher helmet over here. My dad worked for 3M. My grandmother worked for 3M for 40 years. It's a company I have some affinity for. Hopefully I won't find anything bad in the report. What we'll do in this video, though, is take a quick tour of everything that's in the annual report so that you have sort of an overview of where we're going to find things. And then at the end of every week, we'll dive in more detail and try to find that week's topic.
This is an interesting one.
Hope you enjoy the video. So we pull up the 3M annual report, and there's a nice glossy cover, some smiling kids, some benign-looking chemicals. It looks like there are people writing on forms, and then kids drawing pictures. Oh wait, I think I get the theme. There's first the science of 3M, and then there's the impact they have on smiling, happy children. Anyway, we go to the next page, and you get a letter from the chairman and CEO. So this is his explanation of how the company did during the past year. We get some graphs showing that everything's going up. looks like everything is going well with 3M. Then we get a financial summary. By the end of the course, you will not only know what all of these terms mean, but you will realize that this is not enough information to know what's going on at 3M. We have to read through the entire annual report. And if we go to the next page, we get this very ominous looking black and white page. Starts with United States Securities and Exchange Commission at the top, Form 10K. From this point forward, we're looking at the filing to the SEC, and so everything that 3M says or reports here is subject to all the laws in the Securities and Exchange Acts of 1934 and full SEC enforcement. So this is the point where things start to get serious. And then if we go to the next page, it gives us the table of contents. So as a quick overview, in part 1 of the report, we're going to learn a lot about the business. And what I'm going to do in a second is just flip through a lot of these carefully or quickly. You'll look at these much more carefully as we go on later in the course. Part 2 is going to give us the financial information. Key things we're going to find here are the management discussion analysis and, of course, the financial statements, which are the star of the show. And then part 3 gives us proxy-related information, the directors, officers, how much they're paid, and then there's any supplemental exhibits in part 4. Part 1 has the information about the business, and again, I'm just going to flip through this very quickly. If you want to go and read it in more detail, see what kind of things are there, it'll be available on the course platform. And as you can see, it's not that long, so we just got through part 1. And then part 2 starts some information on stock price, selected financial data. Now here's the big thing, management discussion and analysis. This is where management tries to explain to the users of the financial statements what happened during the year. So all the numbers that changed, went up, went down, or didn't change, tries to provide some kind of explanation so that users can understand the financial statements. Although management is being very helpful by giving us all this detailed explanation on what they think happened during the prior year, we still want to be a little skeptical. After all, there have been some companies which have had some big frauds where they've written about things that have happened in the section that didn't really happen. So I like to look at the financial statements and the footnotes first, come up with my own theories for what happened, and then come and see what management's saying about it, just as a reality check of whether I can believe what they're saying. So flipping through here, you can see it's going to be pretty extensive in detail. There's talking about the income statements, business segments, geographic segments, financial condition and liquidity. So we're starting to get some cash flow information. And we're going to come back and look at these once we learn about all of these topics later in the course. There's disclosures about market risk. And then we finally get to the financial statements, which, as I said, I think are the stars of the show. Notice here that there's 2 pages of reports, 6 pages for the actual financial statements, and then 66 pages of footnotes, which right away tells you that the financial statements are probably not going to have all the information we need. We're going to have to dive into these footnotes to really learn what we need to learn about the company. And so we're going to be doing a lot as we go through the course is looking at the details in the footnotes, because that's where all the action is. On the next page, we see 2 of the reports, management's responsibility for financial reporting and internal controls. So as we talked about in earlier lectures, management is responsible for putting together the financial statements. Now, of course, they come in, we hire an auditing firm, public accounting firm, to provide, as they say, an opinion. So the auditing firm says, in our opinion, the consolidated financial statements listed in the accompanying index present fairly in all material respects the financial position of 3M Company and its subsidiaries at December 31, 2012 and 2011, and result of operations and cash flows for the 3 years ended December 31, 2012, in conformity with accounting principles generally accepted in the United States of America. I want to jump in here to point out what the auditor is actually saying here. They're not saying we are giving you an ironclad guarantee that 100% of the things in this statement are completely accurate and true, and you can bet your life on them. Instead, they're saying, in our opinion, these financial statements present fairly in all material respects the financial position, results of operations, in conformity with US GAAP. In other words, we've gone and looked at some of the big things that they're doing. They seem to be following the rules, at least in our opinion. So as we've talked about in earlier videos, the auditors give us a little bit of assurance, but we still need our own healthy dose of skepticism when reading these statements, because we cannot fully rely on what the auditors have done in terms of guaranteeing the accuracy of everything in these statements. The rest of the report talks about internal controls. Thanks to Enron and the Sarbanes-Oxley Act, there's a lot of focus now on internal controls that companies have. Auditors have to audit the internal controls. It's a big part of the job. It's not something we're really going to talk about in this course. Then we see the income statement, balance sheet, statement of stockholders' equity, statement of cash flows. We'll come back and look at these as we learn more material. And then the footnotes start and go on and 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 on. Wow, still not through the footnotes yet. Still not, okay, went too fast. There we go. So the footnotes, 66 pages. Seems very intimidating and very daunting now, but don't worry, by the end of the course, you'll be able to work your way through a lot of these and understand what's going on. The last parts of the report are part 3, which gives us the proxy information, directors, officers, comp. We're not going to talk about these. You can look through them if you're interested. Last part is any exhibits or financial statement schedules. Most of those were incorporated within the financial statements. And we finally wrap up on page 124, which makes this a fairly short annual report these days. I recently used Sony's annual report in my elective class, and that one came in at 279 pages. And I made my students responsible for knowing everything in those 279 pages. So you're getting off a little bit easy here. So that was a quick overview of the 3M annual report. As I mentioned, every week we will come back to it to try to find what we've talked about during that week's video lectures in the 3M financial statement. So the footnotes, 66 pages. Seems very intimidating and very daunting now, but don't work your way through a lot of these and understand what's going on. The last parts of the report are part 3, which gives us the proxy information, directors, I recently used, and do a deep dive through that statement to try to find all the things that we've learned about during the course. So thanks for sticking with me. I realized it was probably a tough week of videos trying to get these basics down of debits and credits and all the vocabulary in the accounting language, but hopefully you stick with it. We've got a couple more tough weeks ahead of us, but I think you'll find by the end of the course it'll be worth it if you stick with us. I hope to see you next week.
This one's not dead information though. I don't care. I don't care about grades.
This is Monday.com
This is
CRM, the
Monday.com
CRM you'll
CRM.
actually want to use. Capture and collect.
Let's see how good we are. It's responsible for preparing its financial statements, the management, right? Which of the following is an asset? Prepaid rent, retained earnings, cash. I remember retained earnings on the right side. Hasn't turned to cash yet, right? Is it? Prepaid rent, you can use it. Common stock. Pretty sure this is liability. But the revenues. Not enough info. Increase of liability. Increase the expense and reduce the liability. There's no liability. Both are credit. Increase return, increase ability, reduce cash, and reduce the expense. This makes sense, you pay for it. I should remember that equation. Service payable. By constructs, there are no transactions. Paying earnings. Which of the following accounts with the increase with the debit? Landing is cash. Ability, prepay insurance. Paying cash to reduce the liability. Credit cash. This one is to increase the asset. This is trying to convert. Most people just get receives cash. This credits cash. To add into retained earnings. Which of the journal entry reflects the following transaction about the underground? ADE might work. I think it separates the two. Inventory debit increased by 10K and then cash, I guess. Credit cash 1K, 10K. Declare 9,000 dividend to be paid, so dividends payable. You don't credit cash here. You do this. I don't care.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to talk about revenues, expenses, and the income statement. This is a fairly important video because we're going to talk in detail about the difference between accounting income and cash flows. Accounting income is determined by something called accrual accounting, which tries to measure business activities and gives a very different picture of the company's performance than merely cash in or cash out. Let's get started and see how this works. As we talked about in the opening video, the income statement reports increases in shareholders' equity due to operations over a period of time. Net income is made up of revenues minus expenses, and there's a couple synonyms that are often used for net income. It's also called earnings and net profits. All the income statement items are based on accrual accounting principles. Now notice I said accrual accounting, not cruel accounting, but this in fact is where the accounting starts to get cruel, because now recognition of revenues and expenses are going to be tied to business activities, not to cash flows, which makes the accounting a little bit more tricky. Revenues are recognized when goods and services are provided, not necessarily when the cash is received. Expenses are recognized in the same period as the revenues they help to generate, not necessarily when cash is paid. And so the bottom line is that net income is not the same thing as net cash flow. So let's look at revenues and expenses in more detail, starting with revenue. Revenue is an increase in shareholders' equity from providing goods or services. There are two criteria that need to be satisfied to recognize revenue. First, it has to be earned, which means goods and services are provided. And it has to be realized, which means that payment for the goods and services is either received in cash or something that can be converted to a known amount of cash. These are called the revenue recognition criteria. For example, let's say that we make a sale to a customer, we deliver the goods to the customer, and we give the customer an invoice which has the dollar amount that they owe us and a time period in which they have to pay us. We've satisfied the first criteria because we delivered the goods to the customer, and we satisfied the second criteria, realized, because even though we haven't gotten cash, we have something that can be converted to a known amount of cash, and that's the invoice which has the dollar amount on it. So in this case, we could book the revenue even before we get the cash. And what we do in this case is create an accounts receivable for what the customer owes us.
Sounds good. But can you give us some examples of when these criteria would not be satisfied?
Why, yes, thank you for asking. Here's an example where the first criteria, earned, may not be straightforward. Let's say you pay $100 to a software company to buy some software for your computer. For the software company, the $100 is realized because they've collected the cash, but they might not book the full $100 as revenue today because it's not all earned. The reason is that you're paying for not only the code that you receive today, but you're also paying for updates or patches that you receive over time, as well as technical support that you might receive over time. So what the software company might do is book $80 of revenue today because that's what they've earned by delivering the code. The other $20 of revenue would only be booked later on as they deliver updates or as they provide technical support over time.
And how about the second criterion?
And now here's an example of where the second criteria, realized, is not exactly straightforward. So there used to be this CEO who was a turnaround expert. I'm not going to mention his name because I don't want to get sued, but what he used to do was get hired by distressed companies, and he would come in and reduce the workforce, streamline the operations, make aggressive accounting decisions, and turn around the company very quickly. On one of his stops, he ended up shipping out a bunch of product to customers that hadn't ordered the product right at the end of the quarter. These shipments allowed the company to book the revenue and meet their earnings targets that analysts had set for the company for that quarter. The justification for booking the revenue was that it was earned because they had delivered the goods, and it was realized because they gave the customers an invoice. The problem is that if the customers haven't ordered the product, they're probably going to send it right back without paying it. And so the revenue really hasn't been realized because you don't have something that can be converted to a known amount of cash, because you don't know the customers have any intention of actually paying for the goods that you ship to them.
That sounds illegal to me.
Yes, in fact, the company I'm talking about got in trouble with the Securities and Exchange Commission for this practice. In fact, well over 50% of the enforcement actions by the Securities and Exchange Commission are for violation of one of these two criteria. So these criteria have a lot of gray area in trying to interpret them, and if companies are going to get aggressive in their accounting, this is often the first place where they get aggressive. Expenses are decreases in shareholders' equity that arise in the process of generating revenues. They're recognized when either the related revenues are recognized or when they're incurred if they're difficult to match with revenues. Now, here we're talking about two criteria, but it's an either or instead of a both. And we're really talking about a distinction between something called product costs and period costs. Now, you also see unusual events there. I'll come back and talk about those in a second. But as an example, think of a company that makes, I don't know, video cameras. For some reason, I'm very interested in video cameras these days. The product cost would be all the direct cost of producing the video camera. It would include raw materials such as plastic, the metal, the glass for the lens. It would include all the labor that went into producing the camera, all the cost of the factory, which we call overhead. All of these are product costs. These product costs would stay in inventory until the camera sold. When the camera sold, those costs would leave inventory and become an expense. So product costs follow the product. When the product is sold, the costs become an expense. Now think of all of the other costs of running a business that makes video cameras. You have to have research and development people, operations personnel, sales force, marketing staff, human resources, top management. Those people are not directly involved in producing the video camera, but they are costs of running the business. We call all of these costs period costs. Later, we're going to call them SG&A, or selling, general, and administrative costs. These costs are recognized as expense when they're incurred. What that means is when the people work for you, you incur the costs, and so you recognize those costs as an expense at that point.
What if the company used the CEO's car to transport parts from the warehouse to the factory? Would that be a product cost or a period cost?
Yeah, in the highly unusual example where a CEO's car would be used to both transport parts to the warehouse and to transport the CEO to his golf game, you would have to take the cost of the CEO's car and split it between product cost and period costs. I'll actually come back to this topic when we talk about the income statement in a future video. The product cost versus period cost distinction is what we call the matching principle, where we try to match expenses to the revenues that they generate. There's also something called the conservatism principle, which is for unusual events. This principle says recognize anticipated losses immediately, but recognize anticipated gains only when they're realized. Another way to look at this is it's the anti-human nature principle. Human nature would be, hey, something good's going to happen in the future, let's record it now. Whereas something bad's going to happen in the future, let's just wait until it happens. The conservatism principle forces you to the opposite. If you anticipate some loss in the future, like an environmental cleanup or settlement on a product liability suit or employee severance costs in a restructuring, you don't wait until those costs actually happen to expense them. You expense them right away as soon as they're anticipated. But if you expect some big gain to happen in the future, like you've signed a new customer to a contract and you expect big profits in the future, you actually have to wait until those profits come. You can't recognize them when they're anticipated. And for this reason, you'll see a lot of big one-time expenses, but not so many big one-time gains. It's because the conservatism principle forces you to anticipate future losses, but not anticipate future gains.
Hey, I didn't know this was going to get political. I am going to leave if this turns into a biased political polemic. I thought the only right versus left debate in the course was debit versus credit.
No, this is not political conservatism. This is not conservatism as the opposite of liberalism. This is conservatism as the opposite of aggressivism. Rest assured, there'll be no political content to any of these videos, and the only left-right debate will be debit versus credit. Now we're going to practice applying these revenue recognition criteria to figure out how much revenue should be recognized in the month of December for each of the following examples. As always, you'll see a pause button, so if you want to pause the video and guess the answer, the pause sign will cue you when you should do that. Let's get started. BOC delivers $500,000 worth of washing machines in December to customers who don't have to pay until February. The answer is $500,000. BOC has delivered the washing machine, so they've earned the revenue in December. BOC has given the customer an invoice, which has them scheduled to pay in February, so they've realized the revenue. With both earned and realized, BOC gets to book $500,000 of revenue in December.
What happens if we never collect the cash? Do we have to cancel out the revenue? It still seems dodgy to me that you can record revenue before you get the cash.
Yes, you are correct that we do have to worry about whether we will collect the cash on this revenue. Later in the course, we'll see how companies try to estimate how much of their revenue they won't collect in cash, and then at the time of sale, make an adjustment to reduce their revenue based on the amount they don't expect to collect. But that's a complication we're going to get to in a few weeks. For now, let's just assume that all of the revenue is eventually collected in cash. BOC collects $300,000 cash in December for washing machines delivered in October. The answer here is 0. Presumably, when BOC delivered the washing machines in October, they also sent an invoice so that they could book the revenue of $300,000 in October when those revenue recognition criteria were satisfied. In December, BOC is just collecting the cash on accounts receivable. They can't book the revenue again, or they'd be double booking it, so there wouldn't be any revenue in December. It was all booked in October. Next, BOC Realty leases space to a tenant for the months of December and January for $20,000, all of which is paid for in cash in December. The answer here is $10,000. We've received the cash, so we know whatever revenue we're going to record meets the realized criteria. But the question is, how much have we earned in the month of December? If BOC is getting paid for December and January, the way they earn revenue is by providing space to the tenant for December and January. BOC's only provided space for December, so they can only record revenue for December, which would be one half of the $20,000, or $10,000. That's the amount that's been earned in December. BOC Aerospace receives an order for a $400,000 jet in December to be delivered in July. The answer here is 0. BOC Aerospace has not delivered any goods or services in December, so they have earned no revenue, which means they can't book any revenue until they actually deliver a jet.
If this is a long-standing customer that promises to pay us, why can't we book the revenue now?
Even if it's a long-standing customer, the revenue recognition criteria still apply. We have to deliver goods or services before we can record revenue. It's just one of those non-aggressive practices that accountants use to increase the reliability or objectivity of the financial statements. BOC Bank is owed $100,000 of interest on a loan for December and receives the payment in January. The answer is $100,000. BOC Bank has earned the interest revenue by providing the money outstanding to its customers. It's provided a service. Presumably, there's some kind of payment schedule with the customer who borrowed the money on when they should pay, so we can consider it realized. And so BOC Bank can book $100,000 of interest revenue in December, even though they won't get the cash payment until January. BOC issues 20,000 shares of stock in December and receives $10 per share, which is $2 per share more than they expected. The answer is 0. Companies can only record revenue when they provide goods or services. They can never, ever record revenue from selling shares of their own stock. It doesn't matter what the proceeds of the stock issuance were, whether they were more or less than expected. Just simply cannot book revenue when you issue your own stock. Revenue is only booked when you provide goods and services. Now let's practice with expenses. So for each of these items, we're going to try to figure out how much expense would be recognized in December. First, BOC Automotive buys engines worth $2 million in December for cash. The answer is 0. BOC has bought engines with cash, but engines are going to be a product cost, so they're not going to be expensed until BOC actually sells the cars that they make with those engines. So at this point, no expense.
Oh, expense.
BOC Automotive uses the engines to make cars at a total cost of $10 million in December. 0. BOC has bought engines with cash, but engines are going to be a product cost, so they're not going to be expensed until BOC actually sells the cars that they make with those engines. So at this point, no expense.
Oh, so you sell and then it's recognized.
BOC Automotive uses the engines to make cars at a total cost of $10 million in December. The answer is still 0. Now BOC has used the engine to make cars. We know how much the cars cost in total, but the cars are still product costs, and the cost won't become expenses until BOC Automotive actually sells some cars.
Come on, now. The question says the words total cost. Cost is just another word for expense, right?
In these videos, I'm going to use the term expense very specifically. Expenses will only refer to things that show up on the income statement. In contrast, I'll use the term cost very loosely. A cost is any cash outlay, whether in the past, present, or future, that's required to run the business. So a cost only becomes an expense when we put it on the income statement. BOC Automotive sells cars costing $8 million in December for $15 million. The answer is $8 million of expense in December. So we can finally recognize expenses because we've sold cars. The expense will be equal to what it costs to make the cars, which is $8 million. The $15 million will be the revenue that we earn from selling the cars. And it's good news in this case because our revenue is greater than our cost, so we've made some profit. BOC Automotive incurs $180,000 in salaries for its marketing staff in December. The answer is $180,000. Marketing staff would be a period cost. We recognize an expense as we incur the cost of the marketing staff, in other words, as they work for us and earn salaries. We don't try to match the cost of the marketing staff to selling future cars, like a product cost, because we assume that whatever the marketing staff is doing, and sometimes it's not clear, is helping us sell cars this period. So the matching principle would say, let's match the cost of the marketing staff this period to the revenues we generated this period, and expense the entire cost of the marketing staff this period. BOC Automotive pays its auditor $50,000 in December for services to be rendered in December and January. The answer is $25,000 of expenses in December. Even though we paid $50,000 cash to the auditor in December, we're paying for work the auditor is going to give us in both December and January. We can only recognize the amount of work they've done in December as a cost and hence an expense. If we assume it's roughly divided between the 2 months, then half of $50,000 will be $25,000 of expenses. The other $25,000 will be expensed in January when the auditor provides the work for us then.
Paying for an auditor is a period cost, right? We pay the auditor $50,000, right? So there should be $50,000 of expense, right?
You're right about auditors being a period cost, but not so right about the other stuff. We're only going to expense the cost of the auditors as they work for us. BOC paid their auditor $50,000 cash for work the auditor would provide in December and January. But BOC only wants to expense in December the amount of work the auditor did in December, which is half of that, or $25,000. Remember, on the income statement, we want expenses to match business activities, not cash flows. BOC Automotive pays $1,200,000 in cash dividends in December.
It's not expense, right?
The answer is 0. Dividends are never considered an expense because they're not considered a cost of doing business. Dividends will never show up on the income statement. They're not an expense. So I think that gave us some good practice in applying these revenue and expense recognition concepts. We'll get a lot more practice in the next video when we start to look at some revenue and expense transactions for Relic Spotter. I'll see you then.
See you next video.
Cool. See you next video.